Hello and welcome to Behind the Charts. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. We sat down with Jeff Huge not too long ago. Jeff is based in Minneapolis. He's the Chief Investment Officer at JWH Investment Partners and also writes a newsletter called Alpha Insights, focused on institutional investors. Jeff had a 20-plus year career in institutional equity sales. He worked at the brokerages Merrill Lynch, Smith Barney, and others. And if you know your technical analysis history, you know that means he worked with some of the giants in technical analysis from years ago. Dick McCabe, Bob Farrell, Alan Shaw, Luis Yamada. These were all technical analysts that he worked with and sold research for. So he knows the craft from learning from some of the very best in the industry. He now focuses on technical analysis as part of a holistic investment process. And what I did not know about Jeff's work, which I really appreciated learning about, was how much he thinks about more quantitative uses of technical analysis. So he thinks about the fundamental and the technical from a quantitative perspective, then layers in the charts during the process as well to understand how the trends relate to the quantitative models. So here's a bit of my conversation with Jeff Huge from JWH Investment Partners. Hey there, everyone. Dave Keller here with StockCharts.com, here with my guest, Jeff Huge. He's the Chief Investment Officer of JWH Investment Partners here outside of Minneapolis, Minnesota. Jeff, thanks so much for joining us today.
Dave, thanks for having me.
Absolutely. So it's been a pleasure getting to know you over the years. I followed your work when I was at Fidelity. Can you, just for everyone, first time that they're getting to know you, can you just talk about your background a little bit, how you got to this point?
Sure. So I launched my private family office about 18 months ago.
Okay.
Prior to that, I worked at the Leuthold Group, and prior to that, directly with Steve Leuthold, managing a global macro fund with him. I was in institutional equity sales for about 25 years before that. I started initially at Merrill Lynch, had the privilege of working with some relatively venerable technicians, Bob Farrell, Dick McCabe, Alan Shaw, Luis Yamada, just to name a few. And my career took me from Merrill Lynch to Smith Barney Citigroup to Oppenheimer before I finally moved to the buy side. My style or my approach to technical analysis was really heavily influenced by those names that I mentioned, and it's really systematic. It's just a process of going through and looking at the weight of the evidence and applying that to your judgment and your decision tree process.
Now, you have the rare, I think, benefit in your past of working with some of the legends of technical analysis, right? So people learning now kind of hear about Dick McCabe and Bob Farrell and Luis Yamada and all these people, and it's so cool that you actually got to spend time, got to sort of build your understanding by working with them. Any specific takeaways that you had from some of them, or anything that you find in your approach now is based on what you learned from them?
Well, there are so many. One thing I will tell you is that Alan Shaw tends to be very focused on the advanced decline line as kind of being his tell for the market. I asked him one time, I said, do you still feel as strongly about it? In fact, this was at the symposium in April in New York, right after Felix Zulauf gave his presentation. He said the advanced decline line probably won't give its usual tell. He doesn't expect it to diverge this time. And so I said, what do you think, Alan? I mean, that's kind of in stark contrast to what you've been preaching all these years. And he said, well, he goes, he might be right, but if I was stranded on a desert island, I'd want two things with me, a bottle of scotch and the AD line. I said, but there you have it, right?
And it's funny now, I mean, we're recording this October 2019, and we've had the situation where advanced decliners actually remain pretty strong, even when the market's chopping around. So, I mean, at least for this point, it seems like that's pretty prescient, I would say, right?
Yeah.
You talked about working in equity sales, institutional equity sales, which is really an interesting background. Coming then into a more of a research role now. Can you talk at all about over your career, which has been a great successful career? How have you seen the appetite for technical analysis change, or have you found that it has grown, shrunk, evolved over time? What would you say to that?
Yeah, that's a great question. When I first got into the business, it was all fundamental. I was encouraged to get my CFA right out of the gate. I had an MBA, And that gave me enough information to be dangerous. But working with portfolio managers, it became clear that they were very interested in earnings estimates and very fundamental type metrics oriented around valuation. And if you put a chart in front of them, they would say that's nice. I can see that the price is going up, and that's good, and we want that. But it was difficult to really get them to agree to many of the sort of points that we might make as technical analysts or as technical analysts, attempting to use the information gleaned from a chart to make a decision. They had already kind of pre-decided what they were going to do based on the fundamentals. However, as things progressed in my career, and as I gained credibility as a technician, I think things changed. You were able to, I think, express the information in the chart a little bit more, how should I say, professionally. So it just takes time, I think, really to get your arms around the body of work and be able to determine where it is going to be most useful to a portfolio manager.
Right.
Analysts, on the other hand, typically have no interest in technicals. The fundamental analysts, that is, they tend to be completely focused on the company's inner workings and operations.
Yep. So you hinted at what I would consider sort of the fusion approach, right? Thinking of the fundamental, the technical, maybe the quantitative, behavioral, whatever else you would do. How do you, when you're working with your clients now, how do you think about the technical inputs, the charts, related to all those other things? Where should it fit in an investor's process, do you think?
Yeah, I think there's a place for all of those things. My process tends to be very systematic. I tend to look at things quantitatively first. Valuation is important. I want to know, am I paying top decile valuation, or am I paying, versus history, or am I paying a price that's a discount? So those things would be important, but at the same time, one has to ask the question, why is it trading at a discount? Or why is it trading at such a high valuation? And in my opinion, that speaks to strength and demand. When things trade at a high value, that's because they're valuable to the person that's paying that price. Right. And if things are not trading at a high valuation, then it's because they're not valuable. And so when we use various technical screens, I'm really looking for things that are going to drive my attention toward leadership and strength. Okay. Relative strength is very, very important to my work. Momentum is very, very important to my work. And if I get, a combination or a confluence of strong absolute momentum, strong relative strength, and things that are pointing to leadership, that's where my attention is going to be drawn, and that's where I want to make my bets.
Got it. Can you talk a little bit more about your process, how you actually look at the charts, right? If it's the beginning of the day and you're getting started, what do you actually go through? You mentioned it's very systematic, but how would you describe it? What is your day-to-day like with the charts?
So we look at U.S. markets, of course, across the board, and I really like to look at the market segmented. So I'll look at the S&P 500, I'll look at the S&P 400, the S&P 600, and just really take that universe of equities and see what they're all doing relative to one another. And the one thing that typically I'm looking for is non-confirmations. So if the S&P is making new highs, but we're not seeing confirmation from mid-cap stocks and small-cap stocks, that's going to be something that's going to be concerning. Okay. Then I look at the sectors, and also style and factor issues as well. And I'm looking to see what is leading. Is momentum leading? Is value leading? Those can be very telling as well. Is it large cap growth? Is it that's leading, and then subsequently small cap growth is lagging? And if you see that sort of a disparity, that's going to give you some information as well. But importantly, I think when you drill down into the sectors and try and understand where the leadership is coming from a sector perspective, you can really determine the character of the market more. For example, the S&P 500 currently trades very close to its highs, within 1% or so. Yet, what has been leading the market? Utilities, real estate, staples. These are defensive sectors. That doesn't speak to strength. It speaks to caution
Right.
and defense and risk off, and so that sort of character makes a move to new highs somewhat suspect unless we see a radical change in that information. Then I drill down into the stocks, of course, and I like to look at each sector and identify where the leadership and where the laggards come from and kind of pair those off. What I've found in some of the portfolios that I manage in-house in my private family office are really driven by non-market performance, but more by independent stock performance.
Okay.
So we're looking to pair off leaders against laggards. And over the course of time, typically a 1-year period of time, we see substantial outperformance by those momentum or relative strength-oriented portfolios. We also look at global markets. I cover regularly 15 international markets. Of those international, there's a variety of developed and emerging. I think about 10 developed and 5 emerging markets. And we also look at some macro areas as well. We cover rates, crypto, currencies, of course, and a variety of commodities. Gold and WTI crude are high on our list as well.
Yeah.
So that's kind of the process, and getting your arms around what's happening from a macro perspective, what's happening from a global perspective, and what's happening internally within the market itself.
That's great. You just very briefly, you mentioned cryptocurrencies just now. How, coming from an institutional background and working with advisors and institutional investors, how do you think about cryptocurrencies relative to other asset classes, or how should your clients be thinking of it at this point?
Yeah, that's a great question as well. I remember back in the early 2000s, around maybe 2001, gold started to kind of show up on my radar screen. And institutional investors absolutely had no interest in gold. It turned out to be one of the best performing asset classes, if not the best performing asset class from about 2001 to 2008.
That's right.
And then 2011 when it finally peaked. But it was difficult to get investors to embrace the idea that something that they couldn't put a valuation on because of its cash flow or earnings had a place in an institutional portfolio. I think crypto is kind of the same animal as gold was back then today. Now, I don't know if Bitcoin is going to have a serious economic position, but like gold, it's going to exist, and it's going to be a place that attracts assets in times of trouble or times when there's skepticism about currency or government or regulation, or it's somewhere else to hide. So I think it's going to exist, and it looks like there are some institutions beginning to embrace the possibility that blockchain and Bitcoin and cryptocurrencies in general are a real asset class.
Got it. Got it. Can you just talk a little bit more about maybe lessons learned, in particular, any maybe painful experiences out of your past investment experience, or any mistakes that you look back and see as a great learning opportunity about market analysis, chart analysis?
Yeah, don't overstay your welcome. I think price change is something that we should embrace as a gift if we're long stocks. When things are going up, don't be afraid to take a profit, especially if you're a shorter term oriented trader. Don't get married to a position. Just because it worked for you for the last 3 weeks doesn't mean it's going to work for the next 3 weeks. It's all time frame, I think, dependent. But to me, being cognizant of where things have come from and where they are important. The flip side of that is don't overstay your welcome on the downside. If something's going against you, don't wait around for it to come back, and don't buy into weakness. Get it out of the portfolio. There's nothing wrong with cash. It gives you time to think. I think Robert Prechter made that statement at one point. At least that's my recollection. Another thing that I think is germane to this whole process is that you should expect change all the time. People, especially trend followers get glued to the trend and they expect it to continue to go up. I think you have to have the opposite view. I think you need to manage your risk and really expect things to go against you all the time. And that forces you to control your position sizing, and it forces you to remain grounded.
I like that. I like that general thinking of just being a little skeptical of the trend, right? And just sort of think of the other side. So if I can ask, you've always struck me as a very laid-back, positive person, but you and I work in a challenging, stressful industry.
Yeah.
So how have you dealt with the stresses of the industry, of the markets, of the uncertainty? Any tricks or tips that you would suggest of how to stay calm and happy through all of this?
Yeah, that's a great question as well. I think you just can't take yourself too seriously.
That's good.
You know, I mean, we're all going to get lucky, and we're going to do well. If you're in this business and you're investing, whether it's long or short, you're going to make some money at some point. Okay, but don't let it go to your head, because the tide changes all the time. And back to position sizing. If you're worried, if you're stressed out, if you can't sleep at night, it's probably because your positions are too big. You've got too much risk on.
Right.
So I would just change that. I would encourage people to really just determine how much they're going to lose before they make any single trade.
Got it.
That's assume you've already lost it, and anything above and beyond that is going to make you very happy.
Right, right. That's great. Now, you write research now called Alpha Insights. Can you talk just a little bit about how that is, how would you describe that approach? What do you offer at this point?
Yeah, so again, just like kind of my daily system, it really is how I approach the markets, and it's just in writing, published. And so I try and make the publication long on data visualization techniques and short on words, because institutional investors don't have time to read 80 pages of number 6 font, okay? But they're more inclined to look at your chart, and if it grabs their attention, move over to your comments on the side, and if you can bullet point a few things, this is what I think is happening in price, this is what I think is happening in momentum, this is what I think is happening in relative strength, and this is the conclusion I would draw from all that, and these are the levels that I would watch. And so, and then, amplify those statements with a big title that says you're bullish or bearish on this, and that will, get your message across. But again, we're looking at U.S. markets and sectors, we're looking at factor and style, and we actually produce some rotation models. So we've got a factor rotation model, a style rotation model, a sector rotation model, and a country rotation model.
Okay.
And the models are very systematic. It's basically being long a certain number of factors that rank highly in our relative strength and momentum work, and not being in the rest of them. And if you follow the models over the trailing 12 months, you would have outperformed the benchmark by a minimum of 100 basis points every time. And in the case of our stock selection model, which is really long individual S&P 500 stocks, the top 5 leaders from every sector, and short the bottom 5 laggards, that would have produced an outsized return of 2,100 basis points above the S&P 500 over the trailing 12.
Not bad.
And by the way, that includes September, which is our worst month ever. We were down 4% in September.
Right.
So what about
even
a lot
with
better?
that? It's still not too bad.
So I'm a big believer in this relative strength and momentum of relative strength. And I think that's really the kicker here, and how we try and differentiate ourselves is really, if relative strength is on the verge of breaking, it's not going to help you too much. But if it's accelerating up and to the right, which is where you want it to be, then, and on the short side, down and to the left, right? Those are the relationships that you're looking for. And it's not perfect. It's not a perfect model, and it's not right every single time. But if you give yourself enough opportunity to be right, and we use 50 positions on the long side, 50 positions on the short side, then I think your odds are pretty strongly favorable.
Right.
And the empirical evidence supports that. Also, I think asset allocation is an important part of our work. And so we work with a lot of advisors, we work with a lot of RIAs, and they're looking for advice for their clients. What asset classes should they overweight? And within those asset classes, where should they orchestrate their bets? And so when we're looking at global markets, for example, we're focused on countries that have an opportunity to outperform. And in the broad non-U.S. markets, nothing's really been working. I mean, that market has been underperforming U.S. markets dramatically if we look at international, developed and emerging. And so, if we can really identify areas within that are doing less bad, and in some cases good outright. Switzerland and the Netherlands, for example, stand out in the developed, and Brazil and Russia stand out in the emerging as countries that have had above average performance in at least recent months and over the last 12 months, I believe. So those are areas that we're trying to focus in on. And then I think with the macro, it's a crapshoot for the most part, but I can't I can't predict the direction of rates any better than the next guy. That's probably my weakest link of my work. If I knew where interest rates were going to be, I could tell you what everything else is going to do with high confidence. But one area that really did jump off the page for us, in the macro area was gold. And we were a little bit early to gold, but the bottom that gold had put in really over the last 4 or 5 years, I think was resolved successfully around July, August, and we saw a pretty big move to the upside, and it's been consolidating the last couple of months. I think really the last 6 weeks, but it looks primed to me to make another move to the upside. So we're sticking with a long gold bet right here, and we're actually looking at the dollar on the short side right now. And so if we're right about the dollar, I think we'll be right about the gold.
So you hinted at a really interesting point, which was the underperformance of outside the U.S. versus U.S., right? Or the outperformance of the U.S. versus the world. I'm always thinking of the potential pain trade, right? What would catch people off guard? And if you have a rotation back outside of the U.S., if you start seeing international markets outperform, it would arguably catch a lot of people on the wrong side that have been mentally pushing it apart. What would you be looking for as a signal to start overweighting or just getting back into international markets? Is it simply the relative performance? Is it the dollar? Is it some combination of things? How would you think about it?
Yeah, I think you hit the nail right on the head. First of all, it's going to be outperformance. If we start to see a turn in that relative trade, that's going to get my attention. The dollar is going to be critical. I think if the dollar weakens substantially, then I think all things non-U.S. dollar denominated are going to do very, very well, and that's going to include foreign markets. And I also believe that if that starts to work, you're going to want to be long beta, because the early innings of a turn of that nature tends to favor the junkiest, crummiest, elements of it, whether it be highly leveraged companies or highly leveraged governments. And so, I would think emerging markets would lead out of that trade pretty aggressively. So I'd want to be focused there. But I wouldn't want to be too early, to be honest with you. I would want confirmation on that trade because we've been faked out, as have many people on the emerging market trade. And you've gotten a lot of false signals. And I think if you're trading emerging markets versus developed markets, non-U.S., it's probably okay to be a little bit early, but if you're going, short U.S., long emerging, I'd want a lot of confirmation on that trade.
Got it. So we're recording this mid-October 2019. Any overall market perspective or take leading into year end? How should investors be thinking about equities at this point?
Yeah. So a couple of things. Number one, investors that have been long the S&P 500 for the last year have earned a little bit more than their dividend. I think the market's up maybe 1 or 2% versus its October levels a year ago, and certainly since the September high in 2018. And the dividend yield on the S&P is about 2% or so. So maybe you've made 3 to 4% on your money. The flip side of that is Treasury bonds have produced a return that's closer to 20 to 25%. So, I think having balance in your portfolio is going to serve you very, very well going into year end, because I don't think that there's a lot of clarity in terms of strong cyclical leadership. We're starting to see some hints of it. In September, we saw a bit of a abrupt shift into the cyclicals and out of what had been leading. Momentum names actually were the defensive names, believe it or not. Not what people would traditionally, focus on as momentum. And we saw, a sharp, almost 5 standard deviation reversal then. That would be something I'd be afraid of. If I saw that a second time, I'd say that it's sending us a real message, right? But going into that, I think having some balance in your portfolio probably can't hurt. I would continue to be overweight those areas that have been leading the market. I don't think that you want to buck the trend here. I think defensives have been leading for a reason, and I don't see anything to lead me to suspect that there's going to be a strong shift there. Having said that, it has caught my attention that semiconductors are beginning to poke their head above on a relative basis. And I've dug a little deeper into the semiconductors to see what's making that tick. And it looks like it's a really bifurcated sector. There are a couple of names that are really standouts, that are really leading the charge. And there are others that are lagging. Intel's a laggard. Xilinx is a laggard. Intel's one of the largest market cap names in there. The flip side of that would be cap equipment names like Lam and KLA. These are leading the charge. Taiwan Semiconductor trading at new all-time highs. So, I think you've got to pay attention to a change of that nature. But at the same time, we need to see stronger participation for us to take it very seriously. And if it is something to pay attention to, you're going to see a lot of other things jumping on board on that ship, and I'm just not seeing it yet.
So if you wouldn't mind, then can we talk just very briefly about your exit strategy, right? So I find a lot of people have really good ways technically of sort of adding position or finding good long opportunities, but taking profits, getting out is what ends up getting them in trouble, right? They'll get out too early, get out too late, sort of struggle with that. Yeah. How would you describe sort of your general exit strategy? Are there certain things you look for or certain charts that you would pay attention to for that?
Yeah, so number one, I would sell slowly.
Okay.
I would buy aggressively and sell slowly. If you've got conviction in an idea, you want to own it. And I think, for example, let's say you buy breakouts and something's been in a consolidation pattern for some time and it's broken out. You want to buy that breakout and you want to hold on to it until it fails. And so to your point, how do you know when it's failed? Right. Well, I like to look at average true range of a specific security. And I think you got to give yourself some breathing room. I've tested this, and you asked me earlier what mistakes have I made. Well, one average true range is not enough for a stop loss. Okay, 2 is a little closer. 2.5 seems to be perfect, and that means that you got to be prepared to take a pretty big loss initially, which means that you can't take too big of a position. Position sizing is important. And so when you make the buy decision, you've already decided how much you're going to lose. Okay, right. Let's say it's 20 basis points or 25 basis points of a total portfolio or capital pool. You've already committed it. You've written that off. I would actually take a write down of 20 basis points off the portfolio in advance. Okay, and if the breakout continues and you don't get stopped out, then there's got to be something that keeps you in, okay? And so what I try and do is I try and set up a series of moving averages. I like to use the 20-day simple moving average as a basic. If it's above the 20-day, I think I can be as aggressive as I need to be in it. If it breaks the 20-day moving average but continues to hold above the 50-day, I might sell a little bit. I might, take a little off the table, typically about a third, okay? If it breaks the 50-day moving average, I would take another half the remaining position off. So I'm down to my last third. And I would hold on to that until it breaks the 89-day moving average. And when we break the 89-day moving average, I'm completely out of the trade. Oftentimes, I don't wait that long. Something else informs my decision sooner. But I think, what often happens is if you sell immediately after you break the 20-day, it hits the 50-day, bounces and takes off, goes through the 20-day again and makes new highs, and you leave a lot on the table. So that's why I say sell slowly.
Got it. It's great advice. Where can people learn more about you and your work if they're interested?
Yeah, my website. It's JWHinvestment.com.
Perfect.
Yeah.
I want to thank our guest, Jeff Huge, for joining us today here in Minneapolis, Minnesota. Jeff, thanks so much for taking the time. This was great.
Pleasure.
Appreciate it. Thanks, everyone, so much.